Now, we're all playing the super game nowadays, but could insurance bonds be genuine rivals? To test this proposition, we have Ross Higgins, the MD of Austock Life, from our Melbourne studio. Ross, thanks for joining us.
Thanks, Peter.
Just tell us quickly about Austock Life.
We're a new start-up life company. We've been in existence just over 13 years. Started the business from scratch, which was quite a surprise to APRA to have somebody come up and say they wanted to kick off a new life company. And we've based our business totally around a modern insurance bond structure.
Okay, so for people who don't remember insurance bonds, and I think people either with grey hair or no hair remember insurance bonds, but they haven't been popular in recent times. Ross, explain exactly what an insurance bond is.
Well, I like to explain insurance bonds these days, Peter, and certainly ours is becoming more and more popular in terms of how they sit beside superannuation, which we all know that super is a tax-paid structure at 15%. An insurance bond is also a tax-paid structure at a headline rate of 30%, but the effective rates of the various funds that we invest into can get down to 21, say 25% for an Australian shares option. So it's a tax-paid structure, but they also have like a preservation period, which with super we know is 55 or 60, depending on when you're born. But with a insurance bond, they actually have a 10-year preservation period. In fact, the bonds that we promote these days have up to a 99-year term. And that recognises that the best phase of an insurance bond is actually in the post-10-year phase. The other really important facet of an insurance bond from a tax structure point of view is that they make tax-free distributions post 10 years and upon death, which is parallel to what happens with super.
Yep, but you're saying that so that after 10 years, let's give us an example. We put $100,000 into an insurance bond. Yes. Along the way, the returns that you make in this bond will be taxed at 30%, right?
Well, depending on the modern insurance bond is a bit like a super fund. There'll be perhaps 30 options. You may put it in an option backed by term deposits. You may put it in one backed by a perpetual Australian shares fund. So you'll pick an option, and that option will have an effective tax rate which by and large is sub 30. So
franking credits could help you reduce the overall tax rate.
That's exactly right. So what's passed up from, say, the perpetual Australian shares geared fund, we use to reduce the 30% rate to, say, an effective 24% rate.
Yeah, okay. Now, but once the 10 years is up, you then get back your capital, the 100,000 plus. Is that right?
No.
Well, that's what a lot of people think.
No.
So clarify.
That's what they think. Yeah. Yeah, well, it's the 10-year misnomer, Peter. These bonds, it's the post-10-year period that's actually better. You keep the bond going for 10, 20, 30 years, and basically the funds that you're invested in will pay the fund tax on your behalf. And it's only if you access it yourself in the post-10 period you won't pay any tax. Just like you don't in a post-superannuation post-60. So personal tax won't apply after 10 years, and we now provide income streams out of our products post 10 years where there won't be any personal tax, similar to what would happen with a superannuation stream.
Okay.
And Peter, the other thing to note that pre-10 years, these products are totally accessible, and there is a very good tax regime to actually draw an income stream out of an insurance bond in the pre-10-year period.
Okay, so some people will actually get a stream of income in the pre-10-year period. Others will keep the money effectively rolling over and take tax-free income streams after that.
That's exactly right, or they'll take a lump sum, or they'll take a periodical amount. It's totally up to them. It's a very flexible way to hold your investments in a tax-paid structure.
Now, okay, now you supplied a chart. Let's see if we can get that chart up, and I'll get you to talk to it if you could. All right, guys, have we got that chart there? There's a chart there.
Well, we don't. Well, I've already covered a few of it off, Peter. You know, or there it is there.
Yeah.
So first of all, with on the left-hand column, we've got what happens with super tax paid at 15% at the fund level. With an insurance bond, each one of the funds, and there might be up to 30 funds that, in respect of a particular insurance bond that you choose a menu from, you'll pay sub 10, sub 30, I should say. Depending on imputation credits, foreign tax credits, which we use to reduce the tax rate, tax-free distributions, which basically means that post 10 years in the hands of the investor, there's no tax to pay. Similar things happens with super. Then you'll have tax-free distributions upon death, which we know that happens with super. Precisely the same thing happens with insurance bonds. You can have menu switching under your superannuation bond, and you have exactly the same situation with insurance bonds. So you could move from, say, a Macquarie cash option or to a Vanguard Australian shares option without any tax to manage, which you'd know well, Peter, that when you switch under a master fund, you're crystallising capital gains or capital losses by selling or buying units in the trust. So
that's right.
There's a lot of rich tax facets to insurance bonds.
Okay, so obviously, Ross, you're going to push this argument because a lot of people just haven't thought about comparing super against insurance bonds.
Well, that's exactly so. We never pretend for a moment that an insurance bond is as good as tax shelter as super. But if you actually analyse pound for pound or kilo for kilo the elements of super and the elements of insurance bond, they're very closely aligned. And although it's not quite as good in the tax outcome, which translates to an investment outcome, they're not that far behind. So, for investors, particularly high net worth, 49% tax rates now, who can't get their money into super because of contribution limits, they might be too old, might have just sold a house in Wallara for $2 million. By definition, you're a high taxpayer. You can't get it into super. You're not. Don't pass the work test. Or it's just somebody who, 42, 43-year-olds, high net worth.
I was going to say exactly that. Who wanted to get their money back before they couldn't wait to 60 or 65. They want at 52.
Absolutely, Peter, and that's what we're finding, that these people who basically want an investment platform that they can choose which funds they go into, much the same as they could super, that are prepared to suffer a little bit more in what the tax outcome is. They're pretty happy to be able to get a holistic tax framework to invest in, and we get quite a lot of inflow for people in exactly that situation, as we do with money coming out of super.
Great stuff,
that
mate.
Can't
Thanks.
be recontributed.
Okay, mate, we're out of time, but if people want to know, what's the website?
www.austocklife.com.
Thanks for joining us.
Thanks, Peter.